immediate reaction from the election, as we covered sort of earlier last month, was very positive, and I think there was a bit of a lull through the month, but as we got to the latter part of the month, I think there was some nominees that were announced that gave confidence to markets that that the government spending that was potentially in order as Trump was coming in was something that would be a little bit more controlled than what it would have been otherwise. So the nominee for Treasury Secretary is someone who's managed money before, as a hedge fund manager, run their own business. So it's a person with practical experience in terms of managing assets and understanding economies from a financial perspective. So I think they were seen as positive. So there's a bit of a pop as they saw clarity around Trump being the nominee. And then it sort of plateaued through the month and then picked up at the latter part of the month. And generally for developed markets were very positive for the month. Emerging markets were negative for the month. But if we focus on the US, as we've been talking about, there's been a little bit of a rotation in the period as well. So the mega cap 7 or 8 companies that had been leading markets and still are having a big influence on the direction of markets. There was more support for the 493, I think it is, if I get my numbers right, that outside of that, as the market started to get more confident around the Trump likely policies that will kick in, which are positive generally for smaller and mid-sized businesses. They're still large businesses when you compare them with Australian companies, in the order of sort of 30, 40, $50 billion type companies. But they had been left behind in the tech rally that we'd seen over the last couple of years. And so, starting to see that rotation. It's a wider spread rally in markets, which had some good momentum as we sort of ended out November, and we're still clicking along and ticking along on record highs. Fixed interest markets were, again, point to point, pretty flat in the month. They were volatile through the month, which is, again, something we've been talking about for some of the recordings we've done throughout 2024. The volatility came in with the election piece. So I think before the Treasury announcement in the US, there were concerns that if Trump did come in and his policies were all put into action, that you're likely to see, I suppose, a bit of excessive spending from the government there. So on that basis, fixed interest markets, if you look at 10-year numbers as the benchmark, they sort of rode out a bit further than what they had, which if you're in those assets, yields higher, prices lower. And so we would have seen a little bit of a pullback in terms of the returns for those assets over, I think it's about the November period. Yields still look appealing, and defensive characteristics in our perspective are still there. So we're comfortable with where yields are at and comfortable with those being in portfolios. The volatility in US bond yields sort of played through the domestic market here a little bit as well. We also had a further update on inflation in the month, which was a little higher if you look at the services impact than what the RBA would probably be looking at. So I think that from an outlook perspective, I think most of the economists here are now sort of predicting that interest rate cuts aren't likely until sort of the mid part of next year, when if we look at the start of the year, it was probably more likely to be late this year or early next year. So it's been delayed. For investors that are cash rich or have got assets, it's not a bad thing. You're obviously getting a better rate of return with where cash rates are today, but that's likely to change at some stage through 2025, midpoint at this point in time, but it could get delayed further depending on how inflation plays out and whether activity sort of stays at the same level that it is at the moment. You never know when things are going to turn in markets. It's very difficult to predict. I think there's been maybe one or two in history probably that have done it well, but probably done it once and got lucky. And so there's a few different types of crises that impact or fundamentals potentially that impact markets that see see heat come out of markets and see a rotation or a bit of a pullback. The likes of COVID that we know that was a bit of a rubber band change where people reacted effectively. They seek liquidity as quickly as they possibly can when there's a crisis. As a long-term investor, that's an opportunity. So you see that if you do have a little bit of money that you have on the sidelines, you see a pullback in markets, and sometimes that's a good time to deploy and find good quality assets at lower prices. There's other times when there's a more of a structural crisis that might be either a significant slowdown in economies that are more structural, or financial crises like we saw in the mid 2000s now, where they're more difficult to predict in terms of how widespread they are and how deep it goes. So, that there we knew property assets were devalued. We knew that banks were heavily leveraged and have been regulated into a different financial situation now, so that's less likely to happen. But they're the ones that are a bit more concerning when you see a financial crisis that comes along. They don't happen often, but when they do, they take longer to recover from. Whereas the likes of COVID, where it was a bit of a let's get our money out, let's see and assess what's going on, and let's have some conviction before we go back. Often that's a quick recovery and can bounce back quite quickly, notwithstanding the inflationary and other impacts that we've had over the last couple of years since COVID. But the washout's relatively quick when you compare that with other crises that have happened in the past. Complacency kicks in though, and that's, we've got valuations that are high and we've had very good markets for a couple of years. So I'm not saying that we're going to see a pullback in markets, but it's a time to be cautious when things are running high and we're seeing record highs in markets. So, and if we reflect on what things look like at the start of this year, I think we had the perception that rates were likely to be lower at the end of this year than what they were at the start. That's played out in many economies, and that's on the back of inflation continuing to ease. So the central bankers' hard work has been done, and we've had a couple of pretty good years in markets. Again, reflecting on the start of this year, there was a number of elections that were likely to play through and investors were concerned about through the year. They've played through and generally have been pretty positive, as we've seen through markets. So UK, other parts of Europe and the US clearly have been the big ones. They're not potentially as big next year, but we've got Japan, we've got Germany and Australia in terms of the elections, some of the major ones, as well as some through South America. So it's going to be interesting again. Hopefully if economies have their way and markets have their way, there won't be too much of an impact on markets. But again, things are performing very well. It's just trying to be cautious with how you deploy your money when things are, when the starting valuations are a bit higher than what they were 12 or 24 months ago.